This is Boomer Life on CL 650.
If I had $1 million, if I had $1 million, well, I'd buy you a house. I would buy you a house. And if I had $1 million.
And we're back. This is Boomer Life on CL 650. Sorry, I just wanted to say I'll buy you a house and you get a house and you get a house. That was my Oprah moment for the day. I am Joanne Sutton. I'm joined by JimDoyle, Senior Financial Consultant with Investors Group. And on Boomer Life today, we are talking about your financial future. A well thought out plan for your financial future is an integral part of building the life that you want for both yourself and for your family. So Jim, when it comes to actually building a portfolio, didn't there used to be an old sort of standard simple rule, something about the percentage of bonds in your portfolio should actually match your age? Somebody mentioned this to me the other day. So basically something like a 60-year-old person would have 60% of their retirement stake in bonds. Is that it? Is that how the formula works?
Yeah, as a rule of thumb, the idea was that as you aged, you should use bonds, which offer dependable payouts and rarely default, to shield more of your money from the wild swings of the stock market, even if that meant sacrificing potential investment gains. But today, in an era of ultra-low interest rates and longer lifespans, that one-size-fits-all approach doesn't work for many people nearing retirement.
So what other alternatives are there?
I have to be honest, in my opinion, I don't think anyone really knows what to replace it with. There's no consensus among professionals about how baby boomers should allocate their savings. That's apparent in the surprisingly wide variations in the allocations of target date mutual funds, which automatically reset the mix of bonds, stocks, and cash, depending on what year investors plan to stop working. At the end of 2014, equity allocations in 54 target funds aimed at people retiring in 2015 ranged from 8 to 68%, and this was according to Morningstar.
8 to 68%, that's a pretty wide percentage. But what about the people who are doing all this on their own?
If you're devising your own asset allocation, you've got to consider a lot of variables, including life expectancy, health, and other sources of income, and do a lot of guessing. People who keep working into their 70s or retire at 62 but have a pension that provides guaranteed lifetime income can afford to keep more money in stocks. A 65-year-old in bad health won't need to increase his or her savings as much as someone who's 65 and might live to 105. There's no cookie-cutter solution. I help clients calculate their current annual expenses and what they expect to need in the future to cover housing, food, travel, and other costs, demand-based retirement planning. The people most at risk are those who don't know how much they're spending each month and don't know their needs versus wants.
We hear that those who are more comfortable financially are probably less inclined to have a handle on what their expenses actually are. Kind of like this doesn't apply to me, right? Do you think this could be a cause for concern?
I think it's crucial to understand that just because you have money now doesn't mean you always will. Once people have a clear idea of their expenses, they can better understand whether they're able to ride out the down years in equity markets. One person's flexibility is another's fixed cost. Is a trip to Mexico every year a luxury you can afford to cut out? It depends on who you are.
Mm-hmm. For a lot of retirees, focusing on getting their investment income right is pretty important. And one of the biggest questions right now might be, where are interest rates headed?
Personally, I don't know where interest rates are going, or by how much. I've been waiting for this answer for probably over 4 years. If interest rates rise by just 1 or 2 percentage points over the next few years, there will be losses in the value of some bond portfolios. When I look at risk and return, I have questions about how long-term bond yields. I have those questions. I'm also concerned about the quality of the holdings that might be riskier than people would like. Many advisors caution against trying to hold or boost income by investing in riskier issues, such as junk bonds. Over the past few years, we've been seeing more folks holding government bonds who are worried about the low interest rates these bonds are yielding. A lot of retirees want to live entirely off their interest and dividends and not touch their principal. It's a psychological issue for a lot of folks who've been savers all their lives. One strategy that does work for investors is building a portfolio or bonds that come due at different times and holding them to maturity, a practice known as laddering. This gives you cash coming in at regular intervals, which lowers the chance that you'd have to sell investments during a market slump to cover unexpected expenses. It also allows you to reinvest money at higher yields if rates are rising.
I think a number of our listeners, and including myself, are probably quite surprised to hear that you could actually lose money from bonds. With future returns a little unknown, what are your thoughts on dividends? Maybe start with explaining what is a dividend.
Well, for those who are not familiar with what dividends are, they're the portions of a profit of a company distributed back amongst shareholders. Their payout history and consistency have been pretty impressive. High-quality dividend-paying stocks can also be an alternative to low-yielding bonds. 11 of the 30 stocks in the Dow Industrial Average yielded more than 3% as of March 12.
There are so many investment choices and aspects of those investments that you need to explore and understand. With so many decisions related to those choices that we need to get right, it's understandable that people experience a little bit of anxiety. I think you can hear my voice going up here. There's discomfort, there's distress, all involved when it comes to making these investment decisions.
There's an old Eastern European saying that the difference between a rich person and a poor person is just 2 cents. The poor person earns $1 and spends $1, and the rich person earns $1 and only spends 2 cents. Well, it probably takes a little bit more than this, but I think the sentiment is right. When it comes to investments, I think we need to look at the ways that people normally make their decisions. After looking at all available choices and considering the potential outcomes and ranking the consequences, people choose investments that they feel most comfortable with. At this point, it's important to know what you don't know.
Yes, I'd have to agree that most people probably feel the same. And as you mentioned earlier in the show, it's not just about choosing investments, but it's about investor behavior, isn't it?
I think it's important to look at all the experiences that help us shape our view of money and investments. Asset allocation is important, but primarily it's investor behavior that really is important. Financial advisors need to frame investment decisions in a way that will increase the likelihood that you'll stick with your plans even when markets fluctuate. In my practice, even well-intentioned clients suffer from decisions that hurt portfolio performance, including trading too much and selling winners early and losers late.
Jim, could you actually give us an example?
Knowing how you make investing decisions sometimes is important as what investment decisions you actually choose. For most investors, financial risk is singularly defined as the possibility of not reaching financial goals. As such, the sole objective of investing is to minimize this risk. I think one of the reasons we're often challenged when we measure success is that when we discuss investment goals and the importance of achieving them, we focus on the amount made rather than how close or how far away we are from actually achieving a stated goal. For example, let me introduce you to John. John's currently 50 years old and wants to retire at 60. His investment portfolio just made 15%, and he's pretty happy about it. When asked, "Are you on track to retire at 60 with his 15%?" he said, "I don't know."
Well, I'll fall into the guilty party category here. First, I'd like to know what he invested in to make that 15%. But joking aside, what do you mean he doesn't know if he's on track for retirement with that return? How does he not know?
Most people don't know where they are because they don't have a plan to refer to or look at. They don't know where they are relative to their goals. They don't have a benchmark. When we talk about investment goals, I think you need an advisor who can help explain things and how they will help you stay invested in strategies even when your portfolio seems to be suffering during market dips. Advisors are called upon to be an anchor in times of crises. Having these discussions before periods of volatility can help figure out how you're going to react to certain outcomes and how you're hardwired.
Jim, you touched on financial literacy earlier, and April is Financial Literacy Month. Financial literacy is not just a problem for students when it comes to teaching money skills. Many parents want to teach their kids, but they're a little bit anxious about their skill sets. What are your thoughts on this?
It's not uncommon that I speak with parents who are looking for a game plan on how to teach the kids essential money skills. It's a skill that many parents admit to being uncomfortable tackling. Anxiety can increase if the parents feel their money skills aren't great, especially if they may not have had a good handle on their own debt or spending or savings choices. For these parents, I'd like to offer encouragement. I don't think you have to be an expert to get started, but it does take a consistent time and effort, and over time, that effort will pay off. It's a great gift that can last a lifetime.
You bet. We hear all the time that optimism and overconfidence tend to drive some of the biggest mistakes that we make. Tailoring that message for kids seems like a great idea. So what sort of things could a parent do?
I think one of the key takeaways here is sharing the mistakes that you've made so that your kids don't make the same ones in the future. We all want to break the cycle of bad financial habit, if at all possible.
You bet. We can all actually learn from our mistakes. Kids get to start making some of their own money decisions early in life once they start getting an allowance. Can we find some teachable moments in getting an allowance?
A parent told me their story about wishing they had started their child on a regular allowance earlier in life. They used to give their preteen money whenever they asked for it, no strings attached. As the child became a teen, the requests for money became more frequent. It wasn't a fun moment when we came to the realization that we hadn't taught our child the value of money. In establishing a regular allowance, we set out ground rules on what the allowance was expected to be used for. When our child ran out of money, there was no more till the next month's allowance. It was a hard lesson to teach, but it was worth it.
You're listening to Boomer Life on CL 650. I'm Joanne Sutton. Today we're speaking with Jim Doyle, Senior Financial Consultant with Investors Group. Financial security is a paramount goal for most Canadians. The need for advice has never been greater. Make 2015 the year that you rediscover confidence in your financial future. When we come back, more on the importance of having a written financial plan and the need for planning for longevity. And remember, we don't know whether it will be a sprint to the finish or if we'll be running a marathon. That's coming up next on Boomer Life on CL 650. And for more information and to get to know Jim Doyle better, please go to his website, jimdoyle.ca, or give him a call toll-free, 1-800-665-7178 or 604-682-5431. This is Boomer Life.
Canada's only weekly radio show dedicated to the baby boomer lifestyle. This is Boomer Life on CL 650.